Today, folks, we need to talk. We are heading to a place of uncertainty again, and in these moments, speculations, high growth stocks get absolutely wrecked, as we're seeing where dividend stocks reign supreme, SCHD crushing the S&P 500. We'll talk about Canadian stocks that are posting earnings doing exceptionally well on the back of tariff war fears, and we got to talk about how all of this encompasses into what I think is going on and just generally how I feel. So if you're on a path to financial independence, if you like talking about the macro here, consider subscribing. I want to do this journey together as we all fight for our own financial journeys. But Canada pushed back after Trump says 25% tariffs, yet again playing Russian roulette with our economies, causing extreme uncertainty and really changing how consumers feel about what they're purchasing. Now, our economy is incredibly small, so whether we do snowbird behavior and go to the US or purchase US products, it's going to be incremental to the impact the US can have on Canada, leading to Tiff Macklin, basically our Jerome Powell, the head of the Bank of Canada here, basically just saying that, if tariffs get implemented, there's a good chance we could see a 3% downside in our GDP this year into 2026. If we don't get tariffs, we could see about a 1.8% increase this year in GDP. So there's a lot of fear in what's going on here. And I think it's hilarious because in moments of these, fear, speculation, all this stuff getting wrecked. I mean, Trump coin, no surprise. Everyone that bought in by the time they heard about it, devastated. I mean, from a high of over $70 to $13. We saw Eric Trump, I believe, who was tweeting, "Oh, it's a great time. You should be buying ETH. Thank me later." And then since that tweet 3 weeks ago, ETH's down like 30%. The broader speculative market, especially with my speculations like Take-Two, Google, Meta, I want to see these tank. And they ain't tanking enough. I'm one of these guys that wants to see raw devastation. I want to see the people that got last in to be the first out. I want to see crying, pain. And I know a lot of people don't like that sentiment, but that's where you get rich. I want to see Google back in the 150s. I want to see Meta, back down in the 600s. Take-Two below 200 would be a dream here. Tesla, can you imagine getting back into the 100s? I mean, these are stocks that I do love from the business fundamentals. Now, whether we talk about the CEOs, regardless, because people in Canada that I know own Teslas have to put bumper stickers on their car because people are flipping them the bird all over the place. So they got to be like, hey, I bought this car before Elon went crazy. Again, probably not helping the underlying Tesla business model, but hey, it is what it is. But NVIDIA here's posting earnings. We'll see if it can revitalize the market. Bitcoin back into the 80s, Palantir down into the 80 price range here. These are stocks that the only people that are gloating about them right now, which I think is hilarious, are the people that bought in the teens, like Palantir, right? They bought in the $10, $20 range. They're the ones that are saying, oh, I don't care what happens. I bought way down here. You guys are the ones that are screwed, which is kind of funny because the silence across the bulls right now is deafening. I mean, it's kind of insane. But I'm really hoping these stocks tank. They open up better opportunities for the rest of you out there. But as somebody that has a complete diverse portfolio, I have balancing acts going on, right? This is why I hold dividend ETFs, because in moments like this, I get cash flow, which SCHD, VDY are going to be pumping up massive checks here soon. The S&P is giving up most of its gains with the Qs now kind of flat for the year. And I'm suspecting with the high valuations that exist in the Qs, with the exception of NVIDIA, if it can continue to crush and raise the whole market, we could be seeing some continued pain ahead for this year. And that is something that I honestly applaud and want because I'm a cost average investor. And unlike all those clowns, all the influencer tools out there that don't have the cojones to show you their actual portfolios or returns, because most of them dramatically underperform. Here I am showing you guys some of my main accounts here, like this account where I hold some of my most speculative plays like Google, like Take-Two Interactive, and I'm not down that materially. My average buy price in this account on Google is 178. Take-Two is 212. I don't mind buying a bit more of these if they do tank materially, but I'm pretty happy with where the positions sit, with the exception of Take-Two. I'm still trying to build out. Want it to be much more material between a bunch of my accounts, but Telus doing really great here. VDY still holding up nicely. We're seeing some good leveling, right? Because these dividend ETFs like SCHD, again, give me that balancing. So if my tech companies come down, they're not a huge percentage of my overall portfolio. They could be impactful, but they're going to get cushioned by these balancing stocks that people will run to for flights of safety in more uncertain markets. So SCHD doing exceptionally well here, offering some, again, really nice returns, up 4.48%, plus this juicy fat dividend check that's about to be coming in. VDY has been flat on the year, and I'm expecting to see a bit of an oomph on the back of bank earnings, but mostly being dragged down by the earnings on Enbridge, which were really great. Enbridge just decided to pull back because it's gone on quite an exceptional rally over the last year. But let's talk about a few stocks that posted earnings that I think are intriguing from a high yield standpoint. I'm going to talk about the banks. We're going to talk about some utilities, but I want to throw MCAN in here. This is one of the weird stocks I don't own. I think my mom owns it in her retirement accounts, and I've been following it, and I'm very intrigued because it's a mortgage-focused company on the back of a lot of mortgage concerns with renewals coming up. This company continues to do exceptionally well. They just increased the dividend yet again. It's got an incredibly low PE ratio. I mean, you look at the growth in the dividend, it's not spectacular, but when you can lock in an 8 to 10% yield, and you've gone from 25 cents a decade ago to today where you're at 39 cents, plus we just had another 5% dividend increase on the back of some pretty exceptional earnings. Like, I'm not talking about huge earnings growth here, but I mean, look at this. Return to the average shareholder in equity was 13.4% for fiscal 2024 compared to 15 in 2023. A mortgage company doing double-digit returns for shareholders is, I don't think, anything to complain about with a 5% dividend increase there. And they're doing the same thing that, Enbridge, or not Enbridge, but Bell has offered, which is the dividend reinvestment plan. I didn't realize that MCAN actually gives a 2% discount on shares reinvested, but they are utilizing this to continue to get cash, right? Because I've noticed that they're issuing shares, and their share issuance is actually continues to trickle to the upside quarter over quarter, probably from some of the dividend reinvestment plan. And speaking of Bell, Bell is, maybe finding a bottom here. We've talked about these being probably near their end of, getting devastated. And I'm glad that I picked up those TELUS shares because I told you guys, TELUS, I'm happy owning it if the turnaround story continues to hold true, and it does. And these are the kind of companies I believe will be cushioned against this tariff war because these are companies that are focused in Canada. They're selling to Canadian users. They should have highly stable revenues regardless of what happens in the Canadian economy. Same with some of these other stocks we'll talk about here because they shouldn't be as affected with some of the direct trades like we see with oil companies. But if you take a look at like Bank of Nova Scotia and BMO posted earnings, we're getting this flip-flopping manner as we usually do in bank earnings where some of the banks do exceptionally well and some of the banks start to underperform. And I'm seeing some signs of concern with Bank of Nova Scotia. It is now down 8.4%, getting back into the high yields that we haven't seen in a little while. Bank of Montreal is a company that wasn't doing very well, but recently has just been turning it around and offering exceptional returns, kind of heading back toward the recent highs we saw in 2022. Will it get back to those highs? I think it can, but I want to talk about some of the underlying fundamentals here because firstly, all these banks are continuing to grow, which is what I said for the bull case on the Canadian banking sector is we need to get past loan loss provisions. We need to get back to a place of stability and less weak loans, right? Because as people's interest payments expand on higher interest rates, when the renewals come up, it lowers the credit quality against the cash flow they currently have to cover those debts, meaning the banks have to put higher loan losses aside in case they default. But Bank of Nova Scotia, from $8.43 billion to $9.3 billion is great revenue growth on a year-over-year standpoint. But when you look at that net income here, guys, it's continuing to deteriorate on the back of like provisions for credit losses. I mean, we're now at $1.16 billion versus $962 million this time last year. They had non-interest expense that were materially higher, meaning earnings per share were absolute garbage for Q1, even though they beat some of the analyst expectations, which I thought was funny because I'm like, they were really guiding for this kind of a horrible earnings period. Not the best thing I want to see. And if we just zoom in here and you take a look at that ratio when it comes to provisions for credit losses as an average of net loans and acceptances, I mean, you're taking a look at something that's been going up materially quite a bit. I mean, again, nothing that is at a level of huge concern or like economic collapse, but it is a trend that I hate seeing because it's continuing to go up. It's not as high as it was, back toward the end, I think, of 2023 when it was 0.65, but it's still a lot higher and loan losses continue to expand, right? Not something we really want to see. I thought they'd be leveling off a bit more, but we seem to be stuck in around this $1 billion range, with the highest being $1.25 billion, which happened in 2023, the last quarter. So we're still in a fairly tight place. When it comes to BMO as an example, their provisions for credit losses actually decreased. Year over year, still up from $627 million to over $1 billion, but substantially down from Q4's $1.5 billion, with total revenue here expanding quite dramatically to $9.26 billion versus $7.6 billion in Q1 of 2024. So great growth for BMO. And if we take a look at the same kind of metrics here when it comes to the provisions on the credit losses as a percentage here, I mean, they're at 0.5, which is down from this time last quarter, and it seems to be leveling off a bit, which is great to see, but it is substantially higher from where it has been in the past, right? So this is what we need to see level off. And when we get a leveling off, it allows for higher, earnings. And we have to get to that place in order to see material bank growth. Now, I am expecting, Royal Bank to crush it because of the HSBC purchase when they bought the Canadian counterpart. Like these companies that have been doing acquisitions like Enbridge have done, they've been able to bolster their bottom line, and it's helped them crush earnings on the back of these more concerning markets. But I think Royal Bank remains the strongest from a loan loss provision standpoint, from a growth standpoint, and it'll be neat to see what TD's earnings look like as well. So you can subscribe for those updates. On the other spectrum, we do have companies like Hydro One and Fortis that I continue to follow as companies that I think are really recession proof, going to be resilient against the back of whatever happens with, tariffs. And these are stocks I don't own yet, but I've talked about adding them to my portfolio along with maybe TELUS, because again, I'm not like a big high yield chaser, but I recognize these companies can offer incredible stability. And with Hydro One, again, this is a company that primarily offers transmission lines in Ontario. It's kind of really fixated in Ontario, and their revenues have been fairly good, right? Not substantial growth, but if you look for the entire year end, 8.48 billion versus 7.8 billion. If you take a look at the total EPS here, like they've done a pretty good job at offering shareholder return. And same with Fortis, though. Fortis, I'm shocked that it is up as much as it's up. It had a really good return, so congrats to anybody that bought the dip when it was yielding closer to 5%. But my concern is that they're not seeing the same kind of growth. They were able to bolster the bottom line, so net earnings were up to 1.82 billion versus 1.7, but their revenue has kind of been stagnating a little bit, that I've noticed. So I'd prefer to buy these companies that are not necessarily as diversified, because Fortis offers better diversification, but these companies that are a little bit more focused like Hydro One are, I think, have more exceptional growth, especially considering the housing problem, trying to expand housing in Ontario. I think this company can benefit greater from an expansion in the economy here. Could level off a bit, but I still think there's better growth for more specialized utility companies that are economically focused in more particular provinces or states in the U.S., depending on what you're looking at. Otherwise, I think one of the best stocks I'm still regretting that I didn't buy that should make its way into my portfolio if I was smart is a company like Waste Connections. Again, I call these stabilizers. I'm sad that I missed the dip in January, because when this thing tanked, I was like, man, what a buying opportunity here. And sure enough, I was right. Stock's up 10%. The yield, again, not yield chasing, but total return chasing. These companies continue to do well. And these are companies that do well, again, on the back of acquisitions, endless expansion when you get immigration growth for waste management in Canada and the United States. These are companies, again, that shouldn't be inflicted by tariffs regardless. And these are companies that continue to grow exceptionally. And the total year from 8 billion to 8.9 billion for 2024, I really think I'm going to, take a look at this company again and try and figure out how it can fit in my my portfolio. But again, guys, this is the market environment that we're currently sitting in, and you got to be very cognizant of what you're doing here. If you're chasing high growth, you have to be willing to accept massive periods of decline that will open up great buying opportunities. But I always recommend finding a balance that works for you, because again, in market environments like this, it's really nice seeing parts of my portfolio kind of take away some of the downside. Yes, it will limit upside, but it gives me continued cash flow to invest every month along with my regular contributions. And again, I get more excited when we start seeing pain and the paper handlers start flushing out of these overvalued companies that should offer correctional periods that are well needed at this point in the market. So we'll see if we continue to get some declining periods. Again, in 2022, guys, the market tanked for almost a year straight. I'd love to see another market environment like that, but I'm a long-term investor, guys. You got a dime in hand the next 15 or 20 years of your life. I'm not looking to get rich overnight. I do have my small-term speculative plays, but again, long term. But I'll pass that question off to you. I'd love to know what you think in that comment section below.